Hello everyone and welcome back to the channel. The United States presents itself as the world's leading defender of the free market. It encourages other countries to lower tariffs, privatize industries, welcome foreign investment, remove capital controls, and allow money to move freely across borders. The public argument is simple. Open markets create competition, efficiency, and prosperity. But if Washington truly believed that unrestricted markets were always the best path to national wealth, American history would look very different. The United States industrialized behind tariffs. It has repeatedly protected strategic industries, rescued major corporations, subsidized domestic manufacturing, restricted foreign technology, and intervened whenever market outcomes threatened national power. So perhaps Washington does not promote free markets abroad because it treats them as an economic religion. Perhaps it promotes a system that helps global money flow back toward the United States. To understand that argument, we need to understand dollar recycling. When the United States imports more than it exports, dollars leave the country. American consumers purchase cars, electronics, oil, clothing, and machinery from abroad. Foreign companies, banks, and governments receive those dollars, but those dollars do not disappear. They are held as reserves, used in international trade, deposited in banks, or invested in dollar-denominated assets. A large share eventually returns to the United States through purchases of treasury bonds, stocks, corporate debt, property, and businesses. That is dollar recycling. The United States receives real goods. The rest of the world receives dollars. Then many of those dollars return as loans and investments into the American economy. This supports U.S. markets, helps finance government debt, and allows America to run external deficits on terms unavailable to most countries. But dollar recycling works most easily when other nations keep their financial systems open. Free trade and free capital movement are not the same policy. Free trade reduces barriers to goods. Capital account liberalization reduces barriers to money. For dollar recycling, the second is especially important. When capital can move freely, wealthy individuals, banks, and corporations can shift money into assets they consider safer or more profitable abroad. Because the dollar is the dominant reserve currency and American markets are the world's deepest, much of that capital moves toward the United States. This creates a strange situation. A developing country may urgently need investment, yet its own savings are used to purchase U.S. Treasury bonds, American property, or Wall Street assets. The country earns dollars through exports. Then part of those earnings returns to the United States instead of financing domestic infrastructure and industry. Dollar recycling is not the only reason Washington promotes open markets. It also wants access for American exports, opportunities for multinationals, and geopolitical influence. But recycling is a major structural benefit of the system. It helps explain why the United States promotes openness abroad while reserving the right to intervene at home. American history is full of protectionist exceptions. The United States relied on high tariffs during much of its industrial rise. It rescued banks and automobile companies during the 2008 financial crisis. It spent trillions during the pandemic. It subsidized semiconductor production. It restricted Chinese access to advanced technology. And when Intel was considered strategically important, the federal government acquired a passive ownership stake in the company. These are not the actions of a state that believes markets should always operate without intervention. They are the actions of a state that uses markets when markets serve national power. The double standard becomes obvious when developing countries attempt similar policies. When they protect infant industries, they are accused of distorting markets. When they use capital controls to prevent money from leaving, they are told they are frightening investors. When they support national companies, they are accused of state capitalism. But when Washington protects semiconductors, restricts foreign investment, rescues corporations, or subsidizes strategic production, the policy is described as national security. The real principle is not that governments should never intervene. It is that weaker countries should remain open, while powerful countries preserve the right to protect themselves. That is why the global free market blueprint is more than an economic theory. It is also a financial architecture. Open trade moves goods. Open capital accounts move money. Dollar dominance gives that money a preferred destination. And American financial markets absorb a large share of the world's savings. So, does the United States promote free markets because it believes they always make every nation richer? Its own behavior suggests otherwise. Washington treats the free market as a flexible instrument, not a sacred rule. It promotes openness when openness allows American goods, corporations, finance, and dollars to move outward. But when unrestricted markets threaten American industry or geopolitical power, the United States becomes protectionist very quickly. The real question is, who is allowed to protect its economy? Thank you for watching. Make sure to like the video, subscribe to the channel, and share your thoughts in the comments.